All right, we're back. Jack of all trades. We got another fantastic store and show for you guys here today. We hope everybody had a happy and safe Fourth of July celebration over the weekend. Jack, we're gonna do a little review today, right, on the Bitcoin 101 Part One and Part Two that we have already shared on this YouTube channel in the past. However, we're gonna do a little bit of a twist on showing them some graphs, some more visualization tools that we can compare and contrast the actual call strategy and put strategy and kind of combine it into one. Is that what we're trying to show here?
Yeah, I mean, one big part is that I have a little bit better graphs, a little bit better visual that can kind of show, instead of just looking at a column of numbers, it gets bigger. You can look at a line that goes higher. You know, people are used to looking at charts and graphs, and when they're degenerately gambling on commodities and futures. But also, that's one part, is just a better visual, I think. And then the other side of the coin is we're going to look at the two strategies we brought up, and one's buying a put against the Bitcoin, the other one's selling your Bitcoin and buying a call. And I think I stated it a couple of different times. It's basically the same thing, and we're going to show the graph, so show that it's basically the same thing and what the subtle differences are, and then hopefully just that will lead us into future understanding of options and how, you know, the relationship between strikes and longs and shorts, and how it's not just so much about a single bet, you know, on, oh, I'm going to buy a call, hope it goes up, and that it's a hedge. So things are in conjunction with an investment. You know, you have an investment, and in conjunction with that, you add options to help you to take away fear and risk.
Yeah, we absolutely. And as a basic options show, we just want to stress how important it is for everybody to grasp these concepts and just have a full understanding of the material that we're showing you, so that we can build on this as a foundation.
Mm-hmm.
And like we say, if you want to reach out to Jack, you can hit him up right here in the comments section below, or go over to Twitter at Jack Viking on Twitter is his handle. You can reach me at First Gator over there on Twitter. But be sure to reach out if there's something you don't understand, or maybe you have an application, a real live situation that you might be able to use these strategies. You're just not quite sure how to do it. We'd be more than willing to help you out with something like that. So feel free to reach out to us, and we'll just do another little review with some graphs and see if we have the material coming up here.
Hold on. I gotta share this screen here first.
There you go.
Are we on?
Yep. There's the spreadsheet that we were looking at.
So, yeah, so this is a spreadsheet. And just quickly, you know, we're doing a thing where, just roughly speaking, because this is hypothetical in the future, where an investor bought Bitcoin at $5,000, and then the price has gone to like around 20,000, you know, up near the new highs. And the reason I picked this out is because this is where maybe people will see, like, I don't think it's going to make new highs, go back down. I want to take some profit. But then they're thinking to themselves, what if it busts through new highs and it keeps going, you know, up, and I don't want to miss out on it going to 50, 100,000. So what we're looking at here is this graph. And so this was one of the first ones we did, which is keep my Bitcoin. Is this big enough for you?
Yeah, that's perfect.
Okay. So I keep my, sorry, these are overlapping. I was having a little bit of a,
no problem.
Leave it there. Okay. So I keep my Bitcoin and I buy a put, and that's going to be how I'm not actually taking my profit, but I'm putting a worst case scenario at a level, you know. And so for this, is what it shows you is that, so we're sitting at 20,000, and, you know, I'm sitting on $15,000 worth of profit, and see how the line is a little bit below. And right there is like the money we spend on the put will drive our profit down at 20,000 to here. Okay, so that'll be like, you know, 13.5. But as you can see, you know, as it goes higher, I make money. Like it just goes up forever. Goes all the way out to here. I make $28,000. It gets to 35,000, and it could go to $1 million, and I'll make $1 million minus what I spent on the option. But that's what you're hoping for, right? Because you make more money. But then if it goes down, if calamity happens, if Bitcoin falls apart, goes to zero, down here at 15,000, so the bottom axis here is at 15,000, our profit will be 8,500. Which is which is almost what we make, because we were up 15, right? So that's where you have to ask yourself, is that enough of the 15? And what's interesting about this hedge, this is a put, is that this is more bullish than the other one I'm about to talk to. So there it is. Basically, you bought the put. We had a video before, so hopefully if you're on this one, you've got a little idea what we're talking about. You bought the put that puts a floor in, and the put is the right to sell. So you put this $15,000, you buy the right to sell Bitcoin at 15,000, and then no matter where it goes below 15,000, you can sell it at 15,000, and then your profit is minus the 5,000 you paid, 15,000, and then plus the premium that you paid. So we'll go down to the where's my sorry.
That's all right.
My geez. Okay. So here's the sorry for the delay. So here's the call. The other way is to do it is to buy a call, and somehow this stuff got moved here. So we'll look at the spreadsheet real quick. Same situation. I buy Bitcoin at 5,000. It goes to 20,000. I've got this profit. And I get in that point where I've got that FOMO of going down or going up. I got a two-way fear. And so by buying, what I chose to do here is I buy a $25,000 call. So this is an upside call. It's like I want to participate on the upside, but I want to take my profit too. So here these are hypothetical prices, but they're roughly correct depending on the time period. So I spend $1,000 on a call. I sell my Bitcoin then in this scenario. I sell it at 20,000. So here I took the profit of the 1,000 that I spent on the call, and then I sell 20,000 against my 5,000. I make 15,000. That gives me a $14,000 cash profit at the time. And then no matter where it goes to the downside, I've just got my 14,000 profit. And if it goes up, once it gets above 25, I'm participating again on the side. So this is what that looks like.
Yeah. So in essence, it's like you're kind of just going to be sitting out until it gets above 25,000, right?
Right. So here's the graph of it. So I'm locked into that $14,000 profit, and I could show that to zero. It's still 14,000. And then here at 20, it's still 14. And like you said, up until 25, I'm stuck at 14. But from then forward, I participate one for one to the moon. And that's, to me, that's what the person is looking for fear. But this, interestingly enough, is when you buy a call, and but I sold my Bitcoin, but it's basically the same structure as the put, but this is actually a little more bearish because I put my floor at 14,000. What I've done is I've sacrificed my 20,000 to 25 profit window, and by sacrificing that, I've put in a higher floor, and so that's like if you were more bearish, you'd rather have that 14,000 profit than the 8,500 profit. So you do this, and either way, you're still gravy on the upside. But if you're more bullish and you're like, well, I don't want to sacrifice that, we've got this comparison. And this, I think, is what, as an educational tool for people who are just getting into options, I think they can find this a little bit interesting. How they're basically the same thing, like in big picture, it's limited downside, unlimited upside in an investment. And because we're doing this, remember, the reason this is all gravy and this is all profit is we're doing this after we have a winning trade. So we made this investment, and this could be anything, but in Bitcoin, I think it's more important because it's such a volatile product. But we've put we bought Bitcoin at 5,000 and then held it up until 20,000. And that's a point where, for whatever the size investor we are, whatever the size investment we have, this amount, we've gotten into a spot where we're nervous. We don't want to give it back. So again, the orange is the long Bitcoin and put. And as you can see, you're locked in at this 85, and then you participate. And like I said before, from this 20 to 25 is where the put strategy actually makes more money. So if you think it's going to be up, if you're more confident in going higher, well, the put makes more money. You see the orange, once it goes above 20 ish, the put strategy, the orange stays above the blue, and then down here, the blue stays above the orange. So the blue is better on the downside. So doing the call and selling your Bitcoin is more bearish. It's what you would do if you're worried, if you think it's going down. If you just say, gun to my head, yeah, I think it's going to fail here, but I want to stay in, then that's the advisable strategy.
Sure. Yeah, it's nice to point out the differences, because you'd think, logically speaking, you would think that a call and a put are opposite, but clearly here they do function very similarly. So it's good to point that out on the graph. I guess I don't really have any other questions. Is there anything else that you want to go over for the viewers that you might have that I don't know about, or?
No, I think if you've looked at, we were a little more detailed maybe in the first one, and you're just looking at, like, this is, to me, the optionality here. It's like you are not giving up your upside, and you're taking a profit because you earn that profit. You took the risk at 5,000. You got that here. You lock it in. The idea here is that, and this will lead into future conversations, that puts and calls aren't really the important thing. It's more if you're buying or if you're selling an option, whether it's limited risk or unlimited risk, and limited reward and unlimited reward. And then where you see strikes are inflection points, and we'll talk about that down the road. But like, you pick your strike and create that inflection point in your P&L chart, and that's really the only difference. And so for here, we've just given you two ways. One is a little bit more bearish. We're going to lock in that blue line. One's a little bit more bullish. We're going to risk this gap down here in the blue to orange, and we want to pick it up there because we're a little more bullish. But either way, we can sleep at night, because if Bitcoin goes to the moon, we're riding along with it. And if it goes to zero, we've got that capital plus a real good profit in the bank. And that's what I think especially beginners should use options for, is to make things safer, not to try to leverage up giant profits.
Right. There you have it, folks. We have two good strategies here to minimize that fear of missing out. Obviously, our example stems from, you made the purchase worked out, so you're locking in a profit. That's very key to remember. We're also going to be sure to go back to our Bitcoin episodes 101, part 1 and part 2, for a little more details on this. And then, like I said, make sure you're very familiar with the concepts here, so that we can build and grow and move forward, because Jack, you and I will put together some more episodes that are going to be a little more in depth. There's a lot to options, so we want to make sure we have the basic foundation set in place. Like we said earlier, be sure to reach out to us. You can hit at Jack Viking to get him on Twitter. You can reach me at First Gator on Twitter, or feel free to comment, like, and subscribe below, and we can answer some of your questions there. Also, we want to let you know we will have a podcast out, just a little behind the scenes view of the episode that we have up here today, and just go ahead and look for the logo. But thank you for tuning in, and be sure to tune in next time on Jack of All Trades.